Hi, this is Brent with Trade Therapy, and welcome back to the Trading Couch, talking about Chevron, our Clarity Spotlight last week. I've been sick, so apologize for my voice, and if I break out into a coughing fit, I apologize. What we're trying to do with our Spotlight last week is answer whether or not the energy sector is really breaking out and on a sector run. Because if it is, leaders should be able to hold shallow pullbacks, and Chevron's going to be our test case. We're going to try to answer in this video whether or not CVX is in a defendable continuation phase, or is this just a late push that's going to roll over and turn into distribution. Before we get started, a quick disclaimer: this video is for educational purposes only. It's not investment advice. Trading involves risk, including the risk of loss. Do your own due diligence. Trade according to your own risk tolerance and your own plan. Full disclosure, we don't have any position in CVX or in the energy sector. Before we go chart to chart, I want everyone to start thinking about the institutional business cycle and start thinking in terms of cycles. If you think about it, institutions don't need to predict. They know where they're headed. What they're trying to do is manage cost and try to increase profitability every step along the way. So what they need is a risk map and repeatable tactics. And so in Wyckofian terms, that really boils down to one thing. Is this accumulation that's going to turn into markup, or is this distribution that's going to roll over and turn into a breakdown? In Elliott wave terms, we have something very similar. Is this a new impulsive structure that's going to break out, or is this going to turn over into a larger corrective period and see it break down? We're going to start with this monthly chart, and what we see is this big, long, high base. We see this really large volume profile because there's been a lot of activity. So we see a very strong base, and then we see this big change of character candle coming up out of here. We see the range expanding on volume. And what does that mean? The high base usually means institutions are building without chasing price. So once price gets up to a rate, they're going to hold it there and they're going to acquire their positions. And while they do that, they're going to keep supply in control. That's why you see price often losing these shorter term moving averages and failing to get up above this ceiling right here, because supply is brought in. And so they're selling into this to force price down to the bottom of the range where they're accumulating. They'll take profits at the top and then turn around and go short and dump supply onto price to bring it back down here to the bottom where they reacquire their positions. And then they just wash, rinse, and repeat that. That's how they build positions. That's how they also build capital. And so when you see a breakout like this, what we're really looking at from Wyckofian terms is we're seeing a jump across the creek here, where you've got this ceiling of the range, and then you see price jump across it right here. This is really where you find out whether or not this campaign is going to confirm or fail. If we jump over to a weekly chart, we can see that we're starting to see some acceptance above this descending ceiling that it broke out of. These declining trend lines represent the ceiling where supply was being brought in to hold price under that. When you see demand greater than supply conditions take hold, that's when you see the break above that and price expansion up out of that. So what we see here is the weekly acting like acceptance in this higher level. And what we're going to be watching for is an acceptance test and not a collapse. We want to see it come back here and hold these shorter term moving averages and not fall back into the range. We're trying to decide, is this Wyckoff markup that the market defends in this breakout area so it can continue on? What we see is price breaking up out of here. And so we're going to see if whether or not institutions can protect their investment and hold it above that. We're going to be watching for the weekly closes, not intra-week behavior, not daily, not hourly. We're going to want to see how week by week, how is the energy sector progressing? And in this case, how is Chevron progressing? Is it holding its shorter term moving averages? We're going to be watching for very quick repair for any dips that come down instead of repeated failures and then falling back into this range right here. In the institutional tactics and plain language, they push price up out of the range. Then they want to check to see if supply is going to come in. They want to see if there's any sellers that have been trapped that are looking to get out. If there is any sellers, they want to draw them out early. They want to absorb that supply without breaking this level down and without having to absorb them at higher levels. Jump over to a daily chart, we get a real clear view of that vertical expansion. We see price with a clean escape out of this long congestion zone with a vertical run separating out. The EMA stack was really compressed, and then you see this expansion. This is what it looks like when demand takes control and institutions are willing to pay up for it. You see that volume pushing price up out of the range right there. Institutions will often use this fast move to force acceptance higher. So what we're going to be watching for is really time-based digestion with shorter body candles. When you see these longer candles like that, you're going to want to see some digestion here or consolidation. This is a jump across the creek. So we're going to be looking for some sort of a backup, and that backup should be represented in more of a time-based backup than a sharp drop backup. We want to see it. We want to see it meander out here, let these moving averages catch up, and we want to see it hold these shorter term moving averages in this area right in here. This is where retail usually gets trapped. They see this breakout, they see strength, and they come piling in, chasing profits. They expect price to keep going, and institutions see strength like this, and then they want to start managing inventory. They want to see if supply will show up. So they'll often cool down price right in this area, do their backup, test these moving averages, make sure that demand is in control. And in the meantime, they shake out all the weak hands and they shake out all of the retail chasers. If we jump over to an annotated daily chart, we see a long range with the descending ceiling. This is where supply is in control. Every time price gets up to this ceiling, supply is reintroduced to push price back down because institutions in Wall Street are still building their positions. Once price breaks above that, demand takes control. You see it breaking out over this descending ceiling, and a behavioral shift from supply being in control to demand being in control of this extension shelf is often where campaigns pause and rebalance exposure. So we're going to be watching to see prices behavior as that plays out. Will price be able to hold above this broken ceiling, but above this range right in here and hold these shorter term moving averages? Or whether or not pullbacks are going to start failing. So we don't want to see a fast reversal. We want to see a longer term time-based digestion and consolidation and back up to the edge of the creek, and not just a real sharp one here. So the jump across changes the regime. The backup test is really where demand proves itself. Can demand defend this new level? If the backup holds, then markup can continue. If backup does not, that's when you see price fall back into the creek. In Elliott wave terms, if price cannot defend these shorter term moving averages, that's when we'll expect to see a corrective, a three-wave corrective wave develop. Strong wave extension needs higher highs and shallow retracements. The failure shows up when rallies lose follow through. So these pullbacks cannot retrace too much too fast. They need to pull back and test the moving averages, but we need to see it hold its bullish path. If CVX can hold these shorter term moving averages and survive this backup or this shallow pullback here, then that tells us that the larger energy sector is experiencing a breakout, is experiencing a run. If the leaders can't hold the shallow breakouts, can't hold the shorter term moving averages and begin falling and losing the shorter term moving averages, then the overall sector rally is failing. And you'll start to see it show up in the other leaders and, of course, in the smaller players throughout the sector. So that's what we'll be watching out for. We don't want to see price give back any advance in any hurry. We want to see a very deliberate process. We want to see averages hold. We want to see markup continuation. That's what we're going to be watching out for. That's all the time we've got for CVX this week. We'll see you back here on the Trading Couch next week.